Hey, in this video, I'm going to talk about qualified annuity and non-qualified annuities. Especially, I'm talking about the tax aspect regarding their income coming out of those annuities. So, for qualified annuities, these annuities are purchased inside IRAs, qualified plans with pre-tax dollars. So distribution both principal and earnings taxable as ordinary income. You can see because you put money in the IRA or qualified plan, it's pre-tax money. You didn't pay tax on it. So the principal is pre-tax money. So earning is not being taxed. So everything coming out when you withdraw, everything gonna be taxed. So it's taxed at ordinary income tax rate. Example like when retirement plan trustee purchase an annuity to provide a pension. Non-qualified annuity. So the annuity contract is purchased with after-tax funds in a non-retirement account. So contributions to non-qualified annuity are made with after-tax dollar. So those after-tax dollar create a basis in the account, and the earning growth are tax deferred. You can see compared to mutual funds, if you have any dividends, interest, capital gains, you would be taxed in that year distributed to you. However, for annuity, you purchase is tax deferred, so also dividend interest will be stay in the account, so you are not being taxed. However, because non-qualified annuity acting because there's this tax deferred the quality, so it's acting like a retirement account, right? So it's not a retirement account, but acting like a retirement account. So when you take withdrawal, which is sometimes called premature distribution from the deferred annuity, not the immediate annuity. So may be subject to premature distribution penalty of 10% on the taxable amount of the withdrawal made prior to age 59 and a half. So you can see for your qualified annuity, whatever qualified annuity is or the annuity in the qualified plan, so they are subject to retirement age rules for IRAs. So if you take withdrawal before 59 and a half, so there's tax and a penalty on it. So this one non-qualified annuity actually acting like a retirement account as well. So if you take withdrawal, actually here is only the interest and the earning will be subject to taxable, subject to tax and the penalty. However, later you will learn that depends on how you tax the withdrawal, especially if you take some lump sum. Is a LIFO coming out, which is all the earnings coming out first. So you basically, if you are 59 and a half younger, you have to pay tax on the earning and plus a 10% penalty on it. So that's something keep in mind there. There's some exceptions. Well, if you take, there's no 10% penalty if you take after 59 and a half. But the earnings still you have to pay tax on it, although you know 10% penalty, right? So if you is in the event of the disability or death, you can tax the distribution. You pay tax, no 10% penalty. Then as a part of the series, substantial equal periodic payments take over annuitant's lifetime expectancy. That's a kind of another rules of IRAs, so you can look into it on IRA's website. So we talk about qualified annuity. So when you take a withdrawal, everything coming out is ordinary income tax, right? However, for non-qualified annuity, the situation is, well, you have original principal that's after-tax money. So all the earnings growth, they are not being taxed, right? So then when you take a withdrawal, so how can you be taxed when you take money out of those annuities? What's the tax situation, right? Here, try to say that when addressing the taxation, it is helpful to understand that tax treatment varies between the withdrawal and annuitization. Here, try to tell you there's different concept within taking money out of non-qualified annuity. One is withdrawal, another is annuitization. Taxation of the withdrawal is fundamentally different than the taxation of the annuity payments. So, withdrawal. I have a video on this, so you can watch that. So basically, it's taxation on non-periodic payment, and it's a lump sum takeout. So kind of like a lump sum takeout. So basically, this they also have these rules say if your policy is issued before 1982 or after 1982. So kind of is a little complicated. However, let's just see the withdrawal can be direct withdrawals, surrenders, pledges assets for collateral. So those are all considered withdrawals. For most annuities, all the money withdrawal or after for all the money withdrawal on or after annuity start date with the normal be taxable as ordinary income until all the earnings have been withdrawn. So basically, it's here try to say is if there's a situation, you have to watch that video. So anyway, so basically for all the policy issued after 1982, doesn't matter you start annuitize on before or later. So all the lump sum you will withdraw, so gonna be LIFO. LIFO means the earning coming out first. So you have to pay tax, possibly penalty if you're younger than 59.5. So if you withdraw, gonna be all taxable, everything coming out gonna be taxable. If you have the earning or those is other earnings, then all the earnings are exhausted, then eating up to your principal, then the principal is not taxed. So basically that's try to say here. So here just to say after the earnings has been withdrawn, additional withdrawal will be considered non-taxable, returns the principal original investment. So that's a withdrawal, LIFO. Remember, withdrawal is LIFO, right? How about annuitization, which is give you periodic income payments. So in this situation, yes, part of the payment is return of the capital, no tax. Part of the payment is earning, is taxable. So how they figure it out? Which part is taxable, which part is not taxable. So that's you have the exclusion ratio. For fixed annuity, you use the exclusion ratio. For the variable annuity, you use the exclusion amount. So I have video for each of that. So exclusion ratio for fixed annuity, exclusion amount for variable annuity. So you can go to watch that video, how this being calculated, that being discussed very detailed in those videos.